Hi, I'm Sidney McKinnon, MD and CIO of Cadiz Asset Management. And welcome once again to another installment of All Things Fixed Income. I'm often asked about whether policy changes or policy uncertainty in particular affects the fixed income or the bond markets. Now, before we actually get to explaining that, I think the first thing we need to understand is that no investor likes uncertainty. We don't like uncertainty, we like predictability, and we like predictability of returns in particular. So the less uncertainty we have, the better for us to make investment decisions. Coming back to policy uncertainty, and I think it's a topical issue at the moment with all the uncertainty happening both locally as well as globally. I think I can isolate maybe three areas of uncertainty when it comes to policy. The first one being political uncertainty. So this is basically when you have a change in leadership or a change in administration. We've seen that now most recently in the States where they've had a change in leadership. They sent a little bit of shockwaves through the system and markets reacted on this. So that's the first one. You have political uncertainty where there's change in leadership and change in administration. The second one is economic uncertainty. And when we talk about economic uncertainty here, we're not quite sure what the levels of growth, for example, are going to be within an economy, what inflation is going to look like in the economy, what the currency volatility is going to be like within an economy. So if there's uncertainty regarding those economic fundamentals, it will most certainly have an effect on your markets, fixed income in particular, because we're talking about fixed income today. The third one I want to highlight, and all of these uncertainties or policies are interrelated. Nothing happens in isolation. We live in a world where everything is interrelated. The third one is monetary policy. We all know once a month, especially in South Africa and across the globe, central bankers sit and they decide about interest rates, whether they're going to be bringing interest rates down, keeping them neutral, or making sure that they are in a position to best benefit our economy. Now, monetary policy is orchestrated and delivered in such a way by the central bankers to ideally benefit the economy of a country as a whole. And if you have uncertainty as far as this is concerned, then most certainly your markets are going to react. What I do want to say is that policy uncertainty and the way in which it happens, whether it is political, whether it is economical or economic, let me use the right words, or whether it is monetary, is not a direct function of how the markets are going to react. Well, let me put that right correctly. The market's reaction is not a direct function of the way in which policy uncertainty unfolds. I'm a great believer in complex adaptive systems. So a system can be, or an environment can portray the same traits as it did maybe 10 years ago, but it could very well react very, very differently. So each and every uncertain event or event that creates uncertainty could potentially let markets, financial markets in particular, and here we're talking about fixed income, let's talk fixed income markets, may react very, very differently. Now, what it does do, when there is uncertainty, there is a reaction, and what this tends to create is a few consequences. The first one being that your markets become a bit more volatile. So Donald Trump decides that he's going to be putting up tariffs, for example. So this is a change, sort of a political uncertainty that we have in his leadership style and what's going to happen. And the markets become volatile. On the day when this kind of thing happens, we saw the US Treasuries become volatile. Even our bond market reacted. We were about 20 or 30 basis points of volatility in the market. Exactly how much that volatility is going to be is very difficult to predict. You don't know whether it's going to be 10 points, 20 points, or 50 basis points. But you as an investor or portfolio manager have to ensure that you've measured the risk as much as you possibly can to mitigate those circumstances within your portfolio. So volatility is one issue that is a consequence of uncertainty. The second one is perception. I'd like to talk about perception for a second. How do you perceive, for example, the perception, or what is the perception of political change? What is the perception of economic uncertainty? And markets tend to react on perception. Exactly how much that's going to be depends on all the parameters at one particular point in time. And you have to assess that. That's why at Cadiz, where we are, we look at things holistically. In other words, we look at all the factors that drive interest rates. And many of those factors at times change and have different levels of strength or different levels of volatility that influences the way in which markets react. So therefore, a holistic approach is very, very important to cut through what I call the noise, so that you can see where the markets are actually going at any one particular point in time. Another consequence of uncertainty, especially in the fixed income markets, and fixed income markets tend to react, the bond market in particular, tends to react a lot quicker than other markets. It is very resilient. It absorbs, if that's the right word, it attracts and absorbs the information very, very quickly, and it's shown through the price movement within the various instruments. And it's shown or is reflected in the instruments through what is known as the risk and the risk premium. What investors, both buyers and sellers, are willing to pay, or what they are willing to spend to be involved in a particular security or particular stock. So there's a risk premium that's associated with it. And these are all supply and demand factors that influence the risk premium. Finally, I just want to touch on one little other consequence, and we often forget about this one, and that is liquidity in the market. Liquidity means how easy things can be traded. And if you have an event of uncertainty, particularly political uncertainty, suddenly human behavior and fear starts creeping into the investors' markets, and people trade because they think they're going to be missing out on an opportunity, or they're going to be too late to an opportunity, or they need to get out quickly and easily, and even panic can ensue. So that affects how you can buy and sell your particular security. Bonds as an example, but it applies to just about every investment out there. So what I'd like to leave you with, how do bonds react, or how does the fixed income market react? Much the same as other markets do, except I think the fixed income markets are very resilient. They absorb and assimilate information very, very quickly. And as a consequence, they will react in that particular way. But the important thing for you as an investor is to ensure that you ascertain the level of the risk. You do your homework, do your analysis, and you mitigate that risk in the most meaningful way that you can. So that's hopefully explaining how the fixed income markets react in policy uncertainty time, or times of policy uncertainty. And hopefully we can take this conversation further in a future date. So from me, that's Sidney McKinnon, MD and CIO of Cadiz Asset Management. I thank you for your time.